Triangles and flags are some of the most popular continuation patterns trend followers use to spot trading opportunities, as they often indicate that the existing trend is likely to resume after a period of consolidation, as you can see in these examples. I will show you exactly how to spot and trade these breakouts in this video. Hello, I'm Fawad Razaqzada, market analyst with Think Markets, and this video is part of our series on trading continuation patterns. Now then, a clean breakout from continuation patterns such as triangles usually precede big moves in the direction of the long-term trend after a period of consolidation. In a bullish trend, such as in this example, it is when price breaks the resistance trend of the triangle that it starts a new upward trend. What must be observed after the breakout is some upside follow-through to confirm demand for the underlying asset is strong. This is because on occasions you will see false breaks leading to a sharp move in the opposite direction. Now, on the side note, the false breakout from a triangle pattern is in itself a tradable pattern, which is something I have discussed in the Trading the Failure of Key Reversal Pattern series, which you can see over here. Anyway, you need to be wary of that risk, which is why a clean break is ideal before stepping in on the long side. Trading continuation breakouts is an alternative approach to taking advantage of established trends. Rather than buying the dip on the retest of support level or following the formation of a particular candle pattern, continuation patterns are completed when price breaks out of a consolidation zone. This is arguably a stronger signal. Consolidations are a graphical representation of the bull-bear battle, and when they are resolved by price breaking out, you have a good idea which side came out on top. Candle patterns on their own, on the other hand, could provide lots of false signals leading to repeated stop-outs. While triangle breakouts could precede big moves, not all last very long. This is why taking profit is important. An objective way to do this is to work out the height of the triangle in terms of pips or points and add this to the breakout point to arrive at a projected target. But the projected target could mean that on occasions you will miss out on big moves. One way to avoid this would be to consider the length of time that price has spent in consolidation. The longer the consolidation, the bigger the resulting breakout is likely to be. So when there is a lengthy consolidation, you may wish to have your target much higher than normal, or maybe take profit on a smaller portion of your position and then swing the rest in case it keeps on going. To show you what I mean and give you one of the best examples, notice how much time gold had spent in this consolidation between 2013 to 2019. And when eventually price broke out, it went on to rise for a sustained period of time, eventually hitting a record high in 2020. Obviously, this is on a much larger scale, but the same logic would be relevant on smaller timeframes like the daily, hourly, or even lower timeframe charts. In contrast, this example of the S&P 500 on the 4-hour chart shows that we only saw a modest continuation following the breakout from a relatively shorter phase of consolidation. In this case, the trade will have most likely been stopped out. So, always consider the length of the consolidation and the overall price action when deciding on a trade based on a continuation pattern. Although it is best to wait for a confirmed breakout before trading the triangle and other continuation patterns, that is not to say that it is the most efficient way of entering a trade. Indeed, continuation breakouts could be anticipated on occasions, meaning you could build a position before the breakout happens for an optimal trade. One way to anticipate this is to look at positively correlating markets. As an example, let's take a look at Apple and Amazon, two technology heavyweights. Apple had already broken out of its own consolidation phase on 4th of June, while Amazon broke out a few days later on 8th of June. So in this case, you could have bought Amazon shares before the breakout took place for an optimal entry, given that the positively correlating Apple shares had already done so previously. Your entry could have been based on the doji candle that Amazon had created here, giving you some bullish signals to preempt the big bullish breakout from the triangle pattern. Obviously, triangle breakouts will happen in both rising and falling markets. In a downtrend, it is the exact opposite of the bullish examples we have discussed in this video. Here, as you can see in the dollar CAD chart, I'm sharing an example of a breakdown from a triangle pattern, but in a downward trend. In the case of a triangle breakdown in a downward trend, the stop loss would need to be above the high made that led to that breakdown. Whereas in the case of a bullish breakout, the stop loss would ideally be placed just beneath the low made that led to that breakout. So, to summarize, triangles are among some of the most popular forms of continuation patterns traders use to enter trades in the direction of the prevailing trend. They have many advantages over other types of entry techniques, but like all other technical tools, have some drawbacks too. In trying to reduce the frequency of false signals, always consider the length of the consolidation and the overall price action when deciding on a trade based on a continuation pattern. You want to see a clean break following a relatively lengthy consolidation. Ideally, the breakout should also be observed in other positively correlating markets. If you found this video useful, please like and share, as this will encourage us to provide more content like this. Please also make sure that you subscribe to our YouTube channel. See you on the next video.